G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers, and today I'm just going to run through a bit of a mini Q&A. We've had a lot of questions sent in, as we always do, so I might just try and knock over a few of these questions for you today. Thanks for sending in your questions. We always do love to get those and try and work our way through them on the 2 cents episodes with Chris on Sunday mornings, and then also these periodic Q&A episodes. So there's been a lot going on over the past few weeks. Bit of turmoil. Also had the election campaign. Interest rate expectations have been on the way down. So there's a lot of things, a lot of jostling happening in housing markets, and we'll just run through a few of the things that are keeping you awake at the moment. So thanks for the first question from Tom. So pretty straightforward, simple question. How do I build passive income through property? It seems that the cash flow is often heading out the door rather than in. Well, yes, absolutely. So Tom, yes, as you rightly point out, residential property often has a relatively low gross rental yield. It might be in the range of maybe 3% for a house, maybe 4%, depending on the city you're buying in, and maybe about, say, 4% for a unit, and possibly a bit higher depending on whether you're buying regionally or in a capital city like Melbourne, where the rental yields tend to be a bit lower. Now, it doesn't take a genius to work out that if mortgage rates are around 6 or 6.5% today, if you're borrowing significantly, you're going to have a cash flow shortfall, even if you've got an interest-only mortgage, which a lot of investors do. So generally speaking, although rents do go up over time, we've got a lot of data over the past 50 or 60 years to show the trend in rents is generally up as households get wealthier and have more to spend. And although the trend in prices is also up over time, if you're borrowing, let's say, 80% of the purchase price, it's very likely in the current environment, you're going to have a negative cash flow in those early years, and possibly for quite a lot of years, depending on what happens with interest rates. So the reason people invest in standard residential property is not really for the rental yield, self-evidently. What they're hoping to do is generate some capital growth over time to grow their equity or their wealth or their net worth, depending on your preferred terminology. Now, there are ways to generate passive income from property, but they tend to be in the more niche aspects of the asset class. So, for example, Airbnb or short stay accommodation, you might see a much higher rental yield for that type of property. But often what that means is that the income is not purely passive. So each time you've got a new tenant, you'll have some cleaning, possibly some repairs, so the property is ready for the next tenant. You've got to take care of bookings, which might mean paying a fee to Airbnb or another platform. And so there definitely are ways to generate an income from property, residential even, but it may not be entirely passive. The other thing that we found is that if you do own property for long enough, eventually it does become a cash flow generating asset, even in the residential space. But I can tell you that from personal experience, even after 20 plus years, by the time you've taken off the property management fees and the rates and the repairs and those little vacancy periods and other contingencies, often even then the cash flow isn't that good. And after tax, it might even be a little bit less. So the question as to how you can generate a passive income from property, I think you probably guessed the answer, is the first most people would focus on generating equity or wealth. And then later in the journey, they either pivot towards investing in stocks and shares, which in Australia is quite a tax-preferred approach for people wanting to generate a passive income, or you pivot towards commercial property, where the net yield, even after the cost, might be considerably higher. So, for example, if you were to invest in an industrial property, like a warehouse, or maybe something like a warehouse with an office attached or something of that nature, the net yields might be in the range of 6 or 7%, sometimes higher than that. Now, again, the income might not be totally passive, but they do tend to come very often. This property type, you could often have a tenant in place or in situ for a number of years. So it's not uncommon to buy a commercial property where you've got a tenant in place for contracted for maybe 5 years or more, even with an option to extend. So I guess some basic mathematics. You've got a commercial property that you're buying for, say, 1.5 million later in the journey when you've created some wealth. Well, that property might be throwing off maybe in the range of $100,000 per annum after costs, so on a net basis. So look, it's something that it might take you some time to get to that point, but that's ultimately where you're more likely to see a significant income from property. Often it's the residential property that gets you the growth, and then it's commercial property that is more of an income-focused investment. So you can run some numbers that are relevant to you. If you need 100K of passive income, well, that's maybe the sort of number you might need to get up to. In the commercial space, if you're looking for 200K, well, you're going to need more than one of those types of property, most likely, or sometimes a dual tenanted property or something like that. So it really depends on your personal circumstances. But in short, residential property, not really a cash flow generating asset. It's more bought for the capital growth in a lot of cases, unless you're somebody who's looking to manufacture some equity through renovation or, for example, subdivision or adding extra space through development. So let's have a look at this second question for today from Jiminy. So how do I, not an entirely unrelated question, I'd say, how do I work out property cash flow and what is acceptable cash flow? So yeah, just to go back to some of the numbers that are around in that previous example, let's say you've got a rental yield of 4% and you're paying mortgage interest on an interest-only mortgage of, say, 6%. Well, it does depend really on how much you borrow and whether or not you're capitalizing some lender's mortgage insurance into the amount that you borrow. But you can start to look at some numbers. So if you've got $1 million property, you might have, say, $40,000 of rental income. And depending on how much you borrow, your interest repayment might be quite similar. But then you've got all the other costs that relate to the property that you need to calculate. So for a unit or a townhouse, that would include things like the strata fees, which are typically paid quarterly. If you're buying a detached or a standalone house, you can have insurance costs. So potentially insurance that covers things like fire and flood, and maybe landlord insurance. And then you've got all the other little bits and pieces of costs like the rates, property management fees, repairs and maintenance, which are hard to predict, but you can make an estimate of how that might look in any given year. And then maybe a contingency for a couple of weeks rental vacancy period, for example. And that gets you to kind of a net figure, which I would say in the current environment is going to be a negative cash flow position. Now, there is a pre-tax and post-tax implication here. In Australia, what you can typically do, if you've got a net rental loss, you can put that onto your tax return, and then you can offset a net rental loss against your other income. So, for example, your salary income, and you help to release or reduce your tax bill in that way, which is one of the reasons that negatively geared properties are popular, particularly for people with a strong income. It's probably, I don't think I've ever met anyone who dislikes the idea of paying a bit less tax. And also there are some other potential on-paper benefits. So for some property types, it may be worth getting a depreciation schedule done, especially on newer builds, actually, that are built post-1985, whereby you might get a building allowance, but also on other types of property as well, if there's been significant improvements or renovations. And that can just be an extra boost to the net loss figure that you can put on your tax return. In terms of what is an acceptable yield and an acceptable cash flow, well, that entirely depends on your situation. If you're a higher income earner and you're paying the top marginal rate of tax, close to 50% now, all in, well, you might be quite comfortable with a cash flow that's fairly significantly negative in the early years before the rents start to increase. But at the other end of the spectrum, if you're an income earner in maybe a lower income bracket and cash flow is a little bit tight, well, you're going to be most likely much keener to see that cash flow closer to neutral. In which case, that probably means looking for possibly cheaper properties, properties with a higher rental yield, which might mean going into the regions. Sometimes it might mean buying, for example, a unit instead of a house, maybe a more modern, slightly more modern property potentially. And so it really depends on your own situation and what tolerance you've got, I guess, for negative cash flow in those early years. Generally, you find rents do increase over time, but then so too do a lot of the other costs associated with property. Like we've seen insurance go up very significantly over the past 4 or 5 years. Interest rates are probably one of the biggest variables, and you'll generally find even though interest rates are expected to go down over the next 12 months, they'll probably be up and down through the cycle. And so it's probably best to run a bit of a stress test and say, okay, well, in the circumstance that interest rates go up, let's say 2 percentage points, how would things look then? Is it going to create undue stress on my personal finances? And you'll actually find that lenders will do that process anyway. Currently, they actually have to stress test you for 3 percentage points increase to make sure you can comfortably afford the repayments in that scenario. And so that'll be probably one of the big variables through the cycles if you're in for the long term. So take a look at some different scenarios. Interest rates are, let's say, a mortgage rate of 6%, but what does it look like at 7 or 8? What does it look like at, say, 4 or 5? And you can start to get a feel for how things might look. And then hopefully you'll get some capital growth over the cycles over time that will compensate for those early years where you've got a negative cash flow. Running short on time, this is only a mini Q&A today. Just a third question for today from AJ. Thanks for the question, AJ. I'm 42. I own my own home. Is it too late to build a property portfolio, or should I look at equities / shares and superannuation only? So, yeah, it's a fairly common sort of a question that we do get. Well, I would say for most property investments in Australia, you generally want to try and take a decade type of view. I think there's a fair amount of costs involved in buying property. So depending on the state or territory, you might have something like 5% to pay for stamp duty. Then you've got legal fees, and you might have other things like building and pest inspections to pay for, which might be another $500 or $600. So generally speaking, unless you're somebody who's going to develop or renovate a property to try and flip it quickly, generally you want to be in the market for a decade to allow the market to deliver you some returns, because you're going to face some costs when you do come to sell as well, not least capital gains tax, which might chew up another 20% of your return. So I guess in that context, if you're 42, you could potentially go through a couple of 10-year cycles before the traditional retirement date. I think if you look through history, there's no hard and fast rule, but property cycles probably go on average for something like 7 or 8 years, sometimes much longer, sometimes shorter. I think it's changed a little bit now in the inflation targeting regime years. I think before we had inflation targeting, property prices generally just went up because the price of everything went up. I think now we get periods where prices might be flat or even negative for a time. But usually if you're owning a property for 7, 8 years plus, you'll go through one full property cycle, which typically involves a boom phase where people are rushing to get in. We've just seen one of those in Perth and Adelaide in recent years, where prices are going up every quarter and people are rushing to get in to avoid paying more 3 or 4 months down the track. So in that context, well, how long does it take to build equity? In my experience, I think normally to generate significant wealth or equity from property investing, you probably need to go through 2 full cycles. And the reason for that is the first cycle helps you to grow a certain amount of equity in a property investment, or maybe two, depending on your circumstances and your borrowing capacity. And then when you've experienced some significant growth in those first investments, then you can redraw some equity to invest in another market in another part of the country. There's a different phase in the property cycle, and then try and catch the next wave. And then when you've got multiple assets working for you, that's when you get this sudden sort of burst of growth in your net worth and your equity. So it might be, two full property cycles to get that kind of result. But if you're 42, the traditional retirement date is around 65 or 67 now for males, something like that. It's a big thing to take into account is your superannuation in Australia. So most people who spend the bulk of their working careers in Australia will have a significant pool of superannuation built up over time. So that's something you need to factor into your overall plan. I think a lot of people, particularly the higher income earners, like to try and max out their superannuation contributions up to the concessional cap. It's a very tax effective vehicle for Australians. So it's easy to ignore when you're younger because, well, it doesn't seem very exciting, the prospect of accessing some funds when you're 60 or 65. But I can tell you, as you get towards middle age and that 60 years old gets a bit closer, you start thinking, yeah, okay, well, maybe this is actually a real thing that I'm going to get to access at some point in the not too distant future. And that's when people start to pay a bit closer attention to their super. So those are some other variables to take into account. When do you plan to retire? Is it maybe around 60? Is it 65? And also just another thing to look at is use of your borrowing capacity. So for example, you said, Jiminy, you've got your own home. But what if you want to upgrade to a more expensive home in a more upmarket suburb or district later on? Well, you might need some of that borrowing capacity to do so. And maybe that would sort of discourage you from looking at the property portfolio approach. And maybe you might take a look at doing shares and super instead. Another possible wrinkle relates to your career. I think at various points in time, at the age you're at 42, you've probably got a pretty good borrowing capacity. But if you were to, for example, start winding down towards part-time work, or if you went 3 days a week or started contracting, well, maybe that borrowing capacity later on might not be so good. And also, if you decided to go out on your own and start your own business, typically it's harder to borrow in those first couple of years for people who start up their own business until you've got a bit of a proven track record and maybe a couple of tax returns that you can show to the bank. So those are just some other sort of factors and variables to think about. But overall, I guess, if you're 42 and you're thinking seriously about doing property, well, you've got a pretty good time horizon and runway there to consider. So those are just a few of the questions for today. We'll cover a few more in our weekly 2 cent segment, as we do every Sunday. And in the meantime, it's back to what's happening in the property market more broadly. So a bit of news out this week. I think CoreLogic said that rents have had their seasonal lift in the March quarter, up another 1.7% to a new high. But they did say that's largely a seasonal thing. And actually annual growth in rents has come right down now to 3.8%. A year ago, it was 8.3%. So what we're starting to see, although the housing shortage hasn't been addressed, people are they're responding to those much higher rents by bunching up. So household sizes are increasing, kids are staying home with their parents for longer, students are getting into share housing or taking flatmates. So we haven't addressed the housing shortage at all. The rental vacancy rates are just leveling off. And we'll probably see rents doing the same thing over the next year or two, less inflation after a massive run up that we've seen over the past 4 or 5 years. I think in the same vein, we're actually seeing construction costs starting to level out now as well, which is also good news for the battle against inflation. And that's about it, I think, for this week. The jobs market figures last week seem to also show a bit of a a general cooling in the economic environment. So we've been through a pretty wild 4 or 5 years, but things are starting to level off a bit now. And hopefully the central bank will have a bit of confidence in May and beyond to start easing interest rates towards a more neutral level, and then possibly a bit more stimulatory as the year goes on. So thanks very much. Keep sending in your questions. Always happy to answer anything we can within the bounds of reality. And we look forward to catching up next time around. Cheers.
Thanks for watching this video on the Rask Network. While you're here, don't forget to like and subscribe so you can get videos each and every day on business, finance, investing, and so much more.